Now can you see the paper, last year paper?
Can, sir. Yeah.
Okay, then I'll first explain the structure of this paper, and it will remain same for this year as well, in the sense, okay, I'll first go through the structure, then I'll come back to that. So you know the duration of the paper is 3 hours. There are 6 questions. Section A, there are 2 sections, section A and section B. Section A, there are compulsory questions, 40 short questions, and in section B there are 5 questions, out of which you have to answer 3 questions. Those are essay type. Even though I said essay type, you don't have to write lengthy essays, but give some descriptive answers and calculation showing how the steps. This one, silent non-programmable calculators may be used. So, as I have told already, be familiarized with the calculator that you are going to use at the exam, and make sure that it is an allowed one. It should not be a programmable calculator. So, and follow the other instructions as well when you answer the questions. Section A again break into sort of 2 parts. First part, you will get 10 questions like this, 10 statements. What you have to do, you have to state whether the statements, each statement is correct or wrong. That means true or false. But it's not only that you have to answer whether it's true or false. The important thing is justification. You have to justify the answer. Why do you, if it is true, why do you say it is true? If it is false, what are the reasons? Don't write lengthy answers, to the point. Maybe 1 sentence or 2 would be enough. Then the second part of that.
So in the section A,
yes.
If you take the first one, to justify it, these American options allow for exercise on or before the option expiration date. That is true. So in order to like justify it, what we have to say, like, sir, in what we all expect to justify, like in that case, what should we say?
Yeah, you in that case you can write this is the definition of the American style option, and it allows this, and in the contrast to that, European style options can be exercised only at the expiry.
Something like that, no?
Something like that. Yes.
Okay.
And the question number 11 to 40, you get MCQ type questions. There will be 4 options, and you can select the correct answer. Then section B, you get essay type of questions. Each question from question 1 to 40, sorry, in the section A, question 1, each question will get 1 mark each for correct answer. Section B, each questions allocate, each question is allocated 20 marks. So at the end of the question, the marks allocation is given. So you can think about how much time to spend on this, and the length of the expected length of the answer. You can divide or decide it according to the proportions of marks given. Sometimes it's not the lengthy. The allocation of marks depends on the complexity or the nature of the calculation that you have to do. So each question may consist of 2-3 subsections. You may ask to do some calculation, give some explanation, do the calculation and interpret the answer. See, interpret the modified duration figure that you calculated. In the subsection B, you calculate the modified duration. In subsection C, your answer you are asked to interpret it like that. So explain things. What are the limits that you have considered before you execute transaction? So these sort of questions you may expect in the section B. Most probably one question may cover only one topic, or maybe slightly other topics which are relevant to the main subject area. There may not be overlaps or mixed things, most probably. And what I tried to say at the beginning, so this you can expect this structure. Section A, Section B. Section A comprised of 40 short questions. First 10 is true false type. The other 30 is MCQ. Then in section B, essay type questions. But don't expect that the first question to be bond calculation, second question to be FX or something like that. There may be some sections which are not covered in this paper that may come as a essay type question in the paper. So get ready to answer any question from what we have covered in the class. Any questions? That's the basic for the briefing about the paper. Any question? And other thing, still we are hoping that we will be able to conduct the exam on 21st February, but not yet confirmed. Remember that. Any questions on that? If you don't have any questions, we can start to discuss this paper. Okay, now tell me, how do you want to move forward? Start from the beginning, from the first question and move forward, or you want to ask, you want to discuss some specific questions? Which way you want? You don't have any preference?
So can you start from the beginning?
From the beginning. Okay. Okay, you have the paper. You can answer the first question. You can see the paper on the screen.
Yes, sir.
Okay.
Yes, can see.
Okay. The first question, the first 10 are true false type questions. First one, American options allow for exercise on a or no before the option expiration date. So as we discussed just now, it is true. That's the nature of American options. They are allowed to exercise at any time before the or no before the expiration date. So the statement is true. The other type of option is European option. European options are allowed only to exercise on the expiration date. What other types of options that we discussed? Any other types of options that we discussed?
European option, which can be exercised only at the maturity.
Maturity, okay. No, other than American and European, any other types? Can you remember we discussed about Asian options and Bermudian options? Okay, if not, just
can you explain, sir?
If you cannot remember about Asian options and Bermudian options, just refer the note. Now, by now you should know these things, at least the names. If we move to the second question, the interest rate risk of a bond is normally lower for higher coupon. So, is it true or false? The interest rate risk of a bond is normally lower for higher coupon. This is about the relationship between interest rate risk and the coupon. Is this true or false?
This is true.
True. Why? What's the justification?
When the coupon is higher, this duration is lower. Due to that, the interest rate risk is lower.
Yes. When the coupon is high, you have high cash flows, large cash flows. So therefore, the duration is low. Duration measures the interest rate risk. So therefore, when the coupon is high, the interest rate risk is of a bond is low. Any questions on that? What about the maturity, relationship between interest rate risk and maturity? What is the relationship between interest rate risk and the maturity of a bond?
When the maturity gets extended, risk is high, and the maturity gets lower, the risk is low.
Yes. When the maturity is high, then the duration is high. Therefore, the interest rate risk is high. Okay. Third question. Positive convexity implies that the prices rise at a decreasing rate as yields fall. Positive convexity implies that the prices rise at a decreasing rate as yields fall. But so you have to think about few areas. Prices rise at a decreasing rate as yields fall. Okay, with the decreasing rate or the increasing rate, forget about it. What happens to the price when yields fall? First thing. What happened to the prices when yields fall?
Prices go up.
Prices go up. Now the question is whether it's at a decreasing rate or at a increasing rate. That depends on the convexity. Then the question is, what is convexity? What is convexity and what is positive convexity?
Convexity is when the price 1% change in yield impact on the price.
No, that's not convexity. What is convexity? Now you can see the board. Can you see the board now?
Yes, sir, we can see the board.
Yes. Okay. Can you remember the relationship between yield and
duration.
price? What is the shape of the curve? As we discussed, when yield increases, price decrease. When yield increases, price decrease. But it's not in a linear fashion. You can remember the shape is like this. When yield increases, price decrease. In the question it says when yield falls, price increase, which is true. This is correct. But the problem is, what is positive convexity? What is negative? What is negative convexity? Convexity is this curvature. It's not a linear thing. How much? So to what extent the graph shows the curvature. So if I draw another one, which has the highest convexity? Red line and the blue line, when you compare these two, I numbered them, one on it, blue and red, which shows the high convexity.
Blue one.
Blue one. This has a high convexity. What does it mean? For a yield change, the price change is different at different levels of the yield. It's not the same for everywhere in the yield. Here, if the yield drops by 1%, price gain would be very minimal. But when it comes to the low yield area, when yield drops by 1%, the price gain would be high. So that is positive convexity. So both these graphs shows positive convexity, but blue one has high convexity compared to red one. Now, if you go back to the statement, it says positive convexity implies that the prices rise at a decreasing rate as yield drops. So, in this area, if yield drops by this much, the price gain is very small. But if you consider the same amount of yield change here, price change is high. So therefore, when yield drops, change in price or increase in price is at a higher rate, not at a decreasing rate. So therefore, this statement is false. And this is in the positive convexity environment. What does it mean by negative convexity? There may be situations when yield drops, price starts to increase but at a lower rate. In this graph, up to some, it shows positive convexity, that which means when yield drops, prices increase it at a higher rate. But in this part, when yield drops, price increase at a decreasing rate. This is called negative convexity. We can see this type of convexity in bonds with embedded options like callable bonds. Any question? Okay, if not, we'll move into the fourth question. Confirmation of a transaction can be done by any employee of the bank who is not engaged dealing activities. Is it true or false?
False.
False. Why?
Normally confirmation is done by back office.
Back office, yes. What is a confirmation?
Confirmation is what front office is agreeing upon on behalf of the bank. that has been confirmed to the relevant counterparty whether it's
Yes, yes, correct.
value remittance.
When the trade is executed at the front office, it may be a verbal communication or maybe an electronic form, and the terms and conditions of the transaction is confirmed by the back office to the counterparty. That will be considered as the legal binding. So that cannot be done by any employees of the bank who is not engaged dealing activities. Yes, definitely front office people, they cannot confirm any trade, but it's not only outside front office, but it has to be authorized persons in the back office, not any employee, not in the front office. We can't say like that. Yes, don't get mixed up. It has to be persons who are not engaged in dealing activities. Not only that, it has to be authorized persons in the back office. So therefore this statement is false. So you have to write the confirmation can be done only by authorized persons in the back office. Question 5. Risk of being unable to find a liquid market for a particular instrument. When the time comes to close out a position or liquidate an investment to raise cash is called funding liquidity risk. Is it true or false?
True, true, sir.
True. Why? Okay. First thing, what is funding liquidity? When you read this type of questions, try to identify the key terms. First, we have to be clear on this. What is funding liquidity risk? What is funding liquidity risk?
That
We
is
discuss.
that is risk of bank is unable to pay its liabilities. I mean debts and all when it's due to settle, something like.
This is the funding liquidity risk. We discuss liquidity risk and liquidity risk in two forms: funding liquidity and what is other one? Funding liquidity and trading liquidity. What is funding liquidity? That's the ability to borrow, generate funds through creating liabilities. What is trading liquidity? Ability to trade any instrument without any market impact and or basically in an efficient manner, without any market impact and within a very short period. So that is trading liquidity. So here, what does it refer? It's, sorry? Here it says risk of being unable to fund a liquid market. For a what does it mean by a liquid market? In a liquid market, you should be able to buy or sell the instrument very quickly without having adverse impact to the price. At the current market price, you should be able to buy or sell whatever the amount you want. So that is the liquid market. So here the risk they are referring is unable to find a liquid market. So that means market is not liquid, that you cannot sell or buy your position quickly without having any market impacts. And it says further, when the time comes to close out a position. So you have an open position now, you want to close out that position, but the market is not liquid to do that. Or liquidate an investment to raise cash. Again, what you want to do, liquidate an existing investment. You want to sell that, but the market is not liquid. So then, up to this point, what does it talk about or explains? This explains trading liquidity, not the market, sorry, funding liquidity. Funding liquidity means you cannot borrow funds from the market due to some reasons. Maybe lenders, they may not willing to lend you, or maybe they don't have excess funds to lend you. That is funding liquidity. So this statement is false, and you can say this describes the funding, described trading liquidity instead of funding liquidity risk. Is it clear?
Yes.
So be careful. Remember all these concepts. If you remember the concepts clearly, these are not that difficult questions. And remember, so you have 3 hours to get 100 marks. To get 1 mark, what is the time allocation? Roughly 3 hours means 180 minutes for 100 marks. So 1 mark is equivalent to
0.8.
0.8, 1.8 minutes. So let's you have less than 2 minutes to answer these questions. But the thing is, it may not exactly same. There may be some questions you may not need even 1 minute. So you can do those questions quickly and save time for other difficult questions. So let's move to the 6th one. Discount rate and yield of a treasury bill are always equal. Again, what you have to be clear on these 2 key terms, discount rate and the yield. Treasury bill is not that relevant, whether it's a treasury bill or any other product, discounted product, whether this statement is true or false. What does it ask? The relationship between discount rate and the yield. Is it true or false?
It's false because yield is always higher than the discount rate.
Yes. Discount rate, sorry, yield is always higher than the discount rate. True, but the current environment better if you can qualify that with in the positive yield territory. if there's no discount only, the discount rate and yield are the same, that is 0. Question number 7. If the repo seller defaults on the repayment of cash, buyer can sell the security to recover his cash. If the repo seller, now we have to be clear on who is this and what are the actions of repo seller. And if the repo seller defaults on the repayment of cash, buyer can sell the security to recover his cash. Is it true or false?
True.
It is true, yes. Who is repo seller?
Repo seller is the one who borrow.
Borrow. The repo seller is the party who borrows funds. So, and the repo buyer gets the security as a collateral. So, if the borrower defaults, then buyer can liquidate the securities and recover his cash. Question 8. Difference between a deposit and a loan is that a deposit is an asset and a loan is a liability of a commercial bank.
False.
False. Why?
Deposit is a liability, loan is asset.
Yes, for a bank, deposit is a liability and a loan is an asset. Correct. Question number 9. The cumulative gap as a percentage of total assets is less than the cumulative gap as a percentage of interest earning assets. So what is cumulative gap? What is total assets? What is interest earning assets? Is it true or false? True or false?
True.
True. Why?
Because cumulative gap of total assets always higher than interest earning assets.
Cumulative gap?
Cumulative gap over total assets is higher than the interest
Yes,
earning.
why? That you have to explain.
Because total asset comprise of everything, but interest earning compares only with one
Yes.
with interest.
Okay. Now you can see the board.
Yes.
Yes. Okay. So indeed, to answer this question, you don't want to worry about what is cumulative gap or how to calculate cumulative. Whatever, that's a figure. So what it says, cumulative gap as a percentage of total assets. That means we are talking about the ratio cumulative gap over total assets. And the other ratio, it says as a percentage of interest earning assets. Cumulative gap divided by interest earning assets. So when we calculate the gap, we don't worry about whether it's total assets or interest earning assets. The gap figure would be the same. If the gap is 10, it would be 10 in both. But the difference comes in the total assets and interest earning assets. So which is high? Total assets or interest earning assets? Total assets, obvious. Total assets comprises of all other non-interest income generating assets. So therefore, total assets is higher than interest earning assets. If you divide, this relationship is valid only for the denominator. So if you divide 10 by 50 and 10 by 40, large number and a small number, what would happen? This ratio becomes low compared to this ratio. So therefore, cumulative gap as a ratio of total assets is less than compared to this cumulative gap divided by interest earning assets. So the statement is the question number 10, indirect quote in foreign exchange refers to price of foreign currency is quoted in domestic currency. So here what you have to identify, what is indirect quote. So whenever you see this type of questions, forget about the other explanation, think about the definition. What is indirect quote, or for at least an example. Then check whether the explanation tallies with that definition. Otherwise, you will get confused. So what is direct quote? What is indirect quote? What is direct quote? What is indirect quote?
Direct quote is price of local currency in terms of foreign currency.
Direct quote.
Yes.
Any other answers? What he says, direct quote is?
No. Direct quote is price of foreign currency in terms of local currency. Other way around. Yes.
Direct quote is price of
Foreign currency
in terms of local
domestic.
currency. That's the definition. But in practically, direct quote is value of dollar is quoted in other currencies. So like USD LKR, USD JPY, currency pairs like that are examples for direct quotes. Clear? currency pairs like USD JP, USD CAD, USD LKR, USD INR, like this. That means whenever USD is the base currency, we call them as direct quote. The definition what he explained is exactly correct. Price of foreign currency in terms of local currency, but practically we have a problem. What is foreign currency and what is local currency when you are in different countries? So therefore, globally, practice is to consider whenever dollar quote as a base currency, then we refer them as direct quote. So if the dollar is in the counter currency, they are considered as indirect quote. So by now you should remember these things. This is simple definition. If you can remember the base currency, counter currency, things like that, now you should be able to answer this question. Okay, now you are clear about what is indirect quote, what is direct quote. Now tell me whether this statement is true or false.
False.
This is false. This gives the definition of direct quote. So shall we move into the next? Okay. The next question, if the present value is rupees 25 million and the future value is rupees 26,607 and 13 on 360 days, rate of return on 365-day count basis is. So the present value is given, future value is given, the time period is given, day count basis is given. You are asked to calculate the rate of return. What is the rate of return? In that you have to do a small calculation.
$6.34.
6.34. Any other answers? Any other answers?
6.34, sir. Same.
6.34, same. Okay. Can you explain how did you get that answer?
Here's the difference. 25 million is the investment, return is 26,607,013. Therefore, the difference is 1,607,013 divided by 25 million, and you have to annualize. Therefore, divided by 360 multiplied by 365.
Okay. The explanation is correct.
Fourth one?
So the present value,
Uh,
sorry, can you see the Excel sheet now?
sorry, sir. Actually, answer is 6.52. I written correct, but I said wrong. 6.52 is the answer.
Okay, can you see the Excel sheet?
Yes, sir, we can see.
You can see. So remember, read the question carefully. It says you get this gain on 360 days. So therefore the period is 360 days. Day count convention is 365. That means you assume for a 1 year there are 365 days. So you can do it in different ways, but he explains. First you can calculate the gain, the difference between present value and future value. If you do that, 26 million something minus 25 million, then you get income, interest income. Then you can calculate the holding period return. What is holding period return? For this 360 days, what is the rate of return? That is the interest income divided by the investment. So you get 6.42 in the annualized rate. What you have to do, adjust this for the day count convention. This return, holding period return, you get for 360 days. So therefore, you divide this by 360, then to annualize, when you divide this rate of return by 360, you get the rate of return per day. Then what would be the rate of return for 365 days? Multiply this by 365, you get this figure 6.52. Or otherwise, you can straight away go to holding period return without calculating this interest. Just divide the future value by the invested value minus 1. You get the same answer. Then you do the annualization as we did in the previous case as well. So that's how you should do calculation on that. If I go back to, you can see the board. Can you see this equation? Can you see the equation?
Yes, sir. Yes, we can
Yes.
see, sir.
Okay. So, and remember, this is a money market calculation. So therefore, the equation to use, future value equals present value times 1 plus interest rate adjusted for the number of days. So this is number of days considered here, divided by number of days per year. I straight away put 365 because in this question it says the convention is 365 days. Now what you have to find is this R. What you can do, take this present value to the left side of the equation, then it becomes FV over PV equals 1 plus R times D over 365. Next step, take this one into this side. So it will become minus 1. Future value over present value minus 1 equals R times D over 365. Then take D and 365 to the left hand side. It would become future value divided by present value minus 1 multiplied by 365, because this division, when we take it to the other side, becomes a multiplication. This multiplication becomes a division. D. Now you can substitute figures. 25 million, 26 million sorry, 26 million something divided by 25 minus 1, 365 divided by 360. If you have to use the equation and do this, I don't think you need that. But what you can do, you can use your knowledge and logically you can come to the answer, derive the answer. So if I am to do this calculation, I don't do this step by step, but I'll key it into the, so at least I write that this straight away in a piece of paper. Like this. So I get 26 million and 607 and 13 rupees for an investment of 25 million. This is the rate of return, but this is 1 plus R. So minus 1, this will give me the rate of return. Then I know I get this for a period of 360 days. So therefore, divide this by 360 days, but I need it for a 365 period. So you will get the answer. No need to remember these equations and do all those calculations. And I think it is easy to divide the numbers and take the minus 1, then subtract these 2 and get the 1,607,13 divided by 25 million. So I think this is easy in terms of number of case.
So here the day count, like day count base is always on the top part, no? Like that is this thing. The 365 is the day count basis, no?
Yes.
It is always over the, like,
What do you mean by always?
like that mean if
you have to calculate the rate of the interest rate of return, yes, then it will appear in the numerator. That depends.
Okay.
So don't try to remember things like that, but follow the logic. I think that's the best way.
Okay.
As I argued here,
Yes.
this is investment, this is final value divided by investment, you get the rate of return plus 1. More than 100% you get here. 1 plus something you get. So subtract 1 to make it the real rate of return. You know for how many days that you get this. Divide by that number of days to get the rate of return per 1 day. Multiply it by the number of days per year depending on the day count convention given.
Okay, so got it. Yes. Important thing is to calculate for 1 day what is the rate, and depend on the you need to
Depending on the yes.
you need to multiply. Yeah.
Yes. So question number 12. This is on regulation side. Banking Act directions on foreign currency borrowings stipulates limits for foreign currency borrowings by licensed banks. In terms of these directions, the short-term borrowing limits are determined based on answer A, total assets as per the latest audited or certified accounts. Answer B, capital adequacy ratio. Answer C, external credit rating. Answer D, all of the above. So basically the question asks based on which the foreign currency borrowing limit is calculated or decided. There's a direction in which there's a limitation for borrowings in foreign currencies for banks. The question is, how do we decide this limit, or based on what? Not how do we do, based on what we decide that limit.
Answer A.
Answer A.
A.
Okay. Any other answers?
Answer D.
Answer D. All of the above. Any other answers? The correct answer is answer D. Yes. The reason is in the regulation in 2018, if I remember, it says it should be a percentage of total assets, but based on capital adequacy ratio and rating. There are two. There's a table given with some marks allocation. Then you have to add those marks depending on the credit rating and capital adequacy ratio. Then based on the total marks that you get, the percentage is decided as a percentage of total assets given in answer A. So therefore, ultimately to decide the limit, you have to consider all three factors. So therefore, the answer is D. The correct answer is answer D. Please refer to the specific direction. I think Mr. Sajun might have discussed this. Definitely, I didn't discuss. Question number 13. A customer has sold you euro against USD 3 months forward. Which of the following would effectively hedge your position? Okay, sorry. Before we move into this question, if I go back to the previous question. So when you see this type of question, before give any answer, just go through the options given. Sometimes in some the advice is before you read the question, you go through the answers, then read the question. That is the advice sometimes given. So however, don't jump into answers because the first one is correct. Yes, this is one of the input that we need. So you read the question, you know that it is as a percentage of total assets as per the audited financial statements or the certified accounts. So don't select that answer. If you do that, you miss these three, and these two are also correct. Therefore, the correct answer is the last one. So when you see this type of question, please read all the options given to you, alternatives given to you. That's why it's better first read this. Then you see there's something all of the above. Then even you know this one is correct, you have to check whether other two are also correct. And you read this first one, you have read all four answers, then you know for sure this is true. It is an input. You are not sure about capital adequacy ratio, but you are pretty sure credit rating also required. Then what do you do? You are sure about the first answer and the third answer, but not sure about this third answer. What do you do? If two of them are correct, you are not sure about this, but there's an option given saying that all of the above are correct. So then, logically, this should be the answer, even though you are not sure this, because there can't be two correct answers unless it says specified. Don't worry, in this exam, I don't use that method. In this, there will be only one correct answer. So be careful or be tactful when you are answering these questions. Okay, now let's move into the question number 8. A customer has sold you euro against USD 3 months forward. Which of the following would effectively hedge your position? Remember, it's asking how can you hedge your position arising from this transaction with the customer. The first one is borrow euro for 3 months, sell euro USD spot, and lend USD for 3 months. The second one, buy dollars against euro 3 months forward agreement. The third option, option C, buy USD spot, borrow euro for 3 months, lend dollars for 3 months. And the next, the option D, all of the above. When you see something like that, be careful. Just go through all other three. See what would be the answer. What's the answer? What's the correct answer?
B.
B. All of the above. Why? How did you get that answer?
B, sir. Second one.
Second one, B.
Yes.
What would happen if you do this? Buy dollars against euro, 3 months forward agreement. Let me switch to the board. You can see the board. So this is your position after entering into the transaction with the customer. Today you don't have anything, but the customer has sold you euro against dollar in 3 months. Is it correct? Customer has sold euro. Yes, customer has sold euro. So therefore in 3 months, you receive euro and you pay dollars. Answer B, what does it say? Buy dollars against euro 3 months forward agreement. Buy dollars against euro in 3 months forward. Yes. If you do this, what would happen? This is a euro buy. From your point of view, as the customer has sold you euro, that means you are receiving euro and paying dollars. This is a 3 month euro buy transaction. Or in terms of dollars, you can say sell USD in 3 months. This is the position in this trade. What do you do here? So since you are receiving euro, to hedge that, what you want to do? Create an outflow in euros and inflows in dollars. Because you are giving out dollars, you are receiving euros. To hedge this position, you want to create exactly opposite positions. Here you do that. You buy dollars in 3 months. So instead of paying, you receive dollars against euro. That means you pay euro. This receipt will be cancelled out with this payment. This payment will be cancelled out with this dollar receipt. So that's fine. So therefore answer B is correct. It will hedge your position. But if I go back to answer A, what does it say? Borrowing euro for 3 months. Borrow euro for 3 months. Sell euro USD port. And lend dollars for 3 months. So what would happen? Today you borrow euro. You receive euro today. What do you do? But this is for a 3 month period. Sell euro USD spot. That means you sell euro and receive US dollar today. So whatever borrowed amount, you sell it, you give it to another party and you receive dollars and you lend USD for a 3 months. So then all cash flows cancelled out. You borrow euro, sell it, receive dollars and invest that dollars. Then what would happen after 3 months? After 3 months, you have to pay euro with interest because you have borrowed euro. Same time, on dollar leg, you receive USD here because whatever the investment lending, that dollar borrower will pay you principal and interest. Then what would happen? You have a receipt in euro, you wanted a euro outflow. Will happen there. You have to pay dollar. That means you had a dollar outflow. You created a dollar inflow. This will cancel out with this. So indeed, this is what you do in a forward transaction. This is what you do in a forward transaction, but this is the opposite of the forward transaction of this. But this is same as answer B. Effectively, what you do. So now answer A is correct, answer B is correct. So there's option of all of the above. So the answer is all of the above. If you read carefully, you will see the answer C is same as answer A, but in different words. Here, what is given? Borrow euro for 3 months. So in the second part of answer C, it says borrow euro for 3 months. You can find this piece as it is, but it starts with buy USD spot. Buy USD spot. This is equivalent to sell euro spot, which is given as the first part of the answer A. Then lend dollars for 3 months. Same as the last part of answer. So all three answers tell you the same thing. So the answer is answer D, all of the above. Clear? Any questions? Question number 14. If AUD USD is quoted at 6652 and GBP USD as 1.2845, what is the GBP AUD rate? Simply, this is a calculation of cross exchange rate. Can you perform the calculation and let me know the answer?
Answer C.
Answer C.
C.
1.9310. Any other answers? Any other answers?
Answer C, sir. C, 1.9.
Answer C. Okay, let's see. Even at the beginning, I have told you, so you cannot learn this subject or these matters just by listening. Passive learning won't work. You have to do calculations, you have to write the equation, solve the equation, do the calculations, then only you will remember these things, you will understand this. Just by listening, it won't work. I don't know even now whether you are doing that. I can't do that. What I can do, I can explain things and I can demonstrate some things, something, not everything. Okay, there are two codes, AUD-USD and GBP-USD. AUD-USD, is it a direct quote or an indirect quote? Huh?
Indirect quote, sir.
Indirect quote. GBP-USD,
That is
Indirect.
also indirect quote.
that is also indirect quote. Both are so two indirect quotes. What's the rule?
Stronger currency divided by weaker currency.
Stronger currency divided by weaker currency. So basically the rule is cross divide base currency in the numerator. So in the pair GBP AUD, the pair is, base currency is AUD. In the pair of GBP and AUD, base currency is GBP. So therefore, the GBP rate should be in the numerator and the counter currency exchange rate should be in the denominator. Even the rule is cross division, that can be applied only when we have bid and ask, two-way codes. But here there's no two-way codes, so the question is simplified. So what you have to do, just divide GBP USD rate, GBP USD rate by AUD USD rate. So 1.2845 divided by 6652. I think you get the answer C. Yes, 1.9310. You get, I think there's a rounding of 1.9309 something.
So small thing.
Yes.
So if we have a bid and ask amounts in here, I didn't get in that. I didn't get that in the class. Sir. If you have a bid,
I didn't hear.
if you have a bid and ask price here, what should we take for the calculation? Because in the class I didn't get it. Actually, if we have
So,
it,
what if there's a bid and ask? What you have to do? Cross divide. Bid divide by offer. Offer divide by bid. Then this is bid. This is offer. Clear? If you have a, instead of just one rate, if you are given a bid and offer, to get the bid, you divide bid by the offer and offer by the bid. Then you get the corresponding bid and the offer. Whenever the rule says cross divide, that implies bid divide by offer and offer divide by bid. Clear? Oh, in this example, indeed, you need not to remember that rule, but still you can do it or use your knowledge. AUD USD 0.6652, what does it mean? 1 AUD equals 0.6652 AUD. Sorry, USD. Correct? Meaning of this is that. What is the meaning of this? 1 GBP equals 1.2845 USD. Now what you want to find? 1 GBP in terms of AUD. How do you get that? You know value of GBP in terms of dollars. You know the value of 1 AUD in terms of USD. Then what you have to find? First find what is the value of 1 USD in terms of AUD. What do you do? Get the reciprocal of this. 1 over 0.6652. If you know $1 is equal to this much of amount of Australian dollars, what is the value of 1.2845 dollars in terms of AU? So that would become 1.2845 into this 0.6652. That's why it becomes the division, and with the base currency exchange rate at the numerator and the counter currency exchange rate at the denominator. So that's the concept behind this proof. Any question? So the answer is answer C. Question 15. Which of the following is most likely to affect the required rate of return on an investment? What's the answer? What is the most, which of the following is most likely to affect the required rate of return? What's the answer?
D.
B or D?
B.
The last one or the second one?
Second one.
Second one. B. Asset risk premium. Any other answers?
Answer D.
D. All of the above.
Answer is B, sir. I think asset risk premium.
No any other answers? Okay, you all work for banks, correct? Correct? At least most of you. So, if I want to get a personal loan, if I want to get a personal loan, what is the rate? Lending rate, personal, housing, or corporate. What are the lending rates? Huh? What are the rates? You don't know. And to the government, what are the lending rates? You don't know lending rates in the market now, or you don't want to reveal.
Personal loans like about 9%, 10%,
Sorry, personal loan about say, okay, 10%,
10%. Housing loans 8%.
8%. For a corporate, okay, government, say, assume for the same tenor, say 5 years. Okay, forget about corporate. For the government, %5, something like this. Okay. What is the difference between 5% and 8%, 5% and 10%, 8% and 10%?
Risk premium.
Risk premium. Risk premium on top of what? If you compare against the government, 5% to 8%, this 3% is the risk premium. 5% to 10%, 5% is the risk premium. Then, is it the only factor including this 10%? What is your required rate of return? 10%. Your required rate of return, 8%. Required rate of return for the government, 5%. Is it the risk premium? 5%. What is this 5%? Is there any credit risk premium in this? No. What is here? What are the things included here in this 5%?
Risk-free rate.
Risk-free rate. Is it the only one? Again, risk-free rate, you can divide it into two, real and nominal. What is the difference between real risk-free rate and the nominal risk-free rate?
Inflation.
Inflation. Okay, government 5% for 5 years. Government 3 months. What's the rate? 4.6. What is this difference? If it is risk-free rate, why don't you lend to the government at 5% for 5 years and same rate 5% for 3 months? Why do you need different rate? Here you have a liquidity premium. So likewise, final rate. So when it comes to this rate of return, it comes from real risk-free rate, then adjusted for the nominal or inflation. You will get nominal inflation rate. Then you add that liquidity premium. Then you add the credit risk premium as well. So the rate of return ultimately, required rate of return ultimately depends on all these things, not only on the credit or the risk premiums. There may be different risk premiums depending on the product. So the answer is not B, asset risk premium. It's not the only factor. Real risk-free rate matters, expected rate of inflation matters. So the answer is all of the above. Question number 6. Oh, any question? So question number 16, what equivalent rate would you pay annually if you were prepared to pay 6% semi-annually? So you are ready to pay 6% semi-annually. What is the rate that you want to pay if you want to pay it annually? Instead of paying every 6 months, you want to pay at the end 1 year. So you agree to pay 6 months every 6 months. But if you want to pay it annually, what is the rate? What's the answer?
Answer is 5.91. The fourth D.
5.91 D.
91.
Any other answers?
Answer
How
C.
did you get that 5.91?
6.09.
Because the semi-annually due to the compounding rate has to be higher than 6%. Because if it is annual, it has to be lower than 6% without doing any calculation. Just at a glance, I thought 5.91 is the answer.
Without doing any calculation. So is that argument correct?
Answer C. I think.
Answer C. How did you get that?
I applied that formula, EAR formula.
Yes. Okay. Basically, what is asked, what is effective annualized rate? Because you are willing to pay 6% semi-annually, then what would be the, if you have to pay the same amount at the end of 1 year period, then what would be the interest rate? It is the effective annualized rate. So logically, which one should be high? Semi-annual rate or the effective annual rate? since you are compounding semi-annual payments, effective annual rate should be higher than the semi-annual. That's the logic. So in that case 5.91 cannot be an answer. And 6% is also out. It can be same as the semi-annual payment. It should be something higher than 6%. So now you have two answers, 6.5 and 6.09. Better to do a calculation, but you might have gut feeling it cannot be 0.5% higher than the 6% or the semi-annual rate. You can go for 6.09 with that argument, but it's not a big calculation. You can do it quickly. So effective annual rate is 1 plus yield in M. Assuming M is compounding frequency per year. That means how many times you compound within a year. So in this example, it is 2 times because it says semi-annual payment. So 1 plus 6%, I can put it as 0.06 divided by 2 because it's semi-annual payment to the power 2. Sorry, you have to subtract minus 1, subtract 1 to get the rate. So if you do this, you will get 6.09%. Clear? So yes, sometimes you may be able to answer the question without doing any calculation. Yes, the first thing, you should know the relationship. See whether you can derive any answer based on that logic. If not, only perform the calculation. So if we move to the question 17, which one of the following yields is used to value a bond? Very straightforward answer. What is the yield that we use to value bonds?
Yield to maturity.
Yield to maturity. Question 18, which bond has the lowest duration? Which bond has the lowest duration? Combination of maturity and coupon are given. Maturity and coupon. So we discussed this. What is the relationship between duration and coupon, duration and maturity? So then what's the answer? If the maturity is high,
Answer is B, sir.
yes. If the maturity is high, duration is high. If the coupon is high, duration is low. So it's asking for the lowest duration. To be the lowest duration, maturity should be low. So out of these 4 answers, C and D out because they have long maturity compared to A and B. So 4-year maturity, maturities will have low duration. Then what you have to do, compare the coupons. If the coupon is high, duration is low. So 6% versus 11%, 11% each. So the answer is B. Question 19. We predict the currency A will devalue. So we take a position that is Answer A, net oversold in currency A, B squared. C, net oversold in currency B against currency A, net overbought in currency A. What's the answer? What does it mean by D value? Then what's the position that you take? What does it mean by D value? Depreciation of currency A. So if the currency depreciate, you expect that currency to depreciate. What do? Will you buy that currency or will you sell that currency?
Answer A, net oversold.
Yes, because the currency is going to devalue, or that means depreciate. So you sell that currency. So answer A, net oversold in currency A. Question 20. If the base currency has a higher interest rate than the quoted currency, then the forward rate will be. It's about forward rate calculation, but you don't have to do any calculation here. If the base currency has a higher interest rate than the quoted currency, then the forward rate will be lower than the spot price, higher than the spot rate, same as the spot rate, none of the above.
Answer
Answer A,
A.
lower than the spot rate. If the base currency has a higher interest rate than the quoted currency. Any other answers? So what's the explanation? Why did you say the answer A? Can you explain that? The equation for forward rate is spot times 1 plus interest rate for counter currency divided by 1 plus interest rate for base currency. I ignore the time adjustment here. This is the exchange or the equation for the forward rate. So what would happen if RC, the interest rate on the counter currency is higher than the interest rate on the base currency? This ratio will be greater than 1. Then S into a number which is higher than 1, you will get a more figure more than S. So if this ratio is greater than 1, you get forward rate. In this scenario, you will get forward rate higher than the spot rate. If counter currency interest rate is less than the base currency interest rate, in that scenario, forward rate would be lower than the spot rate, because this ratio becomes a figure less than 1. When you multiply a number by another number which is less than 1, you get a smaller number compared to the original number. So you get forward rate lower than the spot rate. That's the scenario given in this example. So the forward rate will be lower than the spot rate. Question 21, the treasurer wants liabilities and doesn't want assets in the 1 month sector. I think this was discussed by Perry. Correct? Hello.
Yes, it was discussed.
So we'll skip that. We can
Yes,
save.
it was discussed.
Yes, we can save time. And the next one also. Which of the following is not a framework for ALM function? So the answer is D. But I think again it was discussed. Question 23. According to Banking Act directions on market conduct and practices for treasury operations, can a person who does not have a required qualification have the required qualifications be appointed to engage in treasury operations? So in that direction on the market conduct and practices, it has listed some of the qualifications, including this Treasury Diploma conducted by IBSL. So any person to work in Treasury, they should have one of those qualifications. That's the basic requirement. The question is about that. If a person does not have that required qualification, the question is whether he can be appointed to the Treasury, or if possible, how? What's the answer? You should know the answer for this question, for sure.
I think the answer is D.
D.
Yeah, I think the answer is D.
D. Okay. Any other answers?
It's A.
A. Such persons shall not be appointed. Okay. So in this group, there are
The answer is B.
B can be appointed with the approval of the board. So yes, the answer is B. That's what the direction says. So if you think about, I don't know, there were people in this group, those who are already in Treasury. So why do they follow this course? To get this qualification. Oh, because they need it to be, if you want to be there according to this guideline. But without this, they are still in the, already in the Treasury. So there's no way that it to say such person shall not be appointed. There are provisions that can be done at beginning, but subsequently they have to get that one of these qualifications. So it's not that you can appoint without any approval. That has to be done with the board approval, and subsequently they have to fulfill the requirement. So the answer is B.
So what? Sorry, sir. What's the answer?
B, with the board approval. Not the
Now when it says, no, actually when I was reading, now it doesn't say monetary board, no sir. Now it says board. Now how do you know which board?
It's the bank board. If it is monetary board, it's specifically said board. Monetary board.
I got confused because since it said board, like not specifically given, that's what I selected the D. Okay.
All directions. If it is monetary board, it will specifically mention monetary board, but read it within the context. You will realize that, I think. Question number 24. When we borrow funds for 1 year and lend them for only 6 months, we make a profit. If I think this is also discussed, correct? Last week. So you borrow funds for 1 year and lend them for 6 months. Then you create a positive gap, because after 6 months, your assets will realize and you will get cash. You have a positive cash flow. Your liability is for 1 year. So in that sense, you can make a profit if interest rate increases, because you can reinvest your proceeds for the next 6 months at a higher rate. Question number 25. 1 year interest cost is 5% while dividend payment is 7%. Spot index is 11,000. 1 year futures price would be. What would be the answer? This is about futures contract and pricing futures contract.
Below 11,000.
Below 11,000. Why?
Because cost of holding is negative. There is no cost of holding. Rather, there is a gain.
Okay. Yes. So if you are to buy today, you have to pay 11,000. Cost of that is 5%. For that 11,000, you have to incur a borrowing cost of 5%, because the interest rate is 5%. But once you buy this index, you get dividend payments of 7%, which is higher than borrowing cost. So there's a negative cost of carry. That means you have a benefit. So therefore, futures price should be below 11,000. Which is the current market price. Question 26. Okay. Shall we take a break here? We finish up to here. Question 25. We'll take a small break,
Sir,
about 15 minutes.
sir,
Yes,
is this the last class, sir?
today.
Today is the last class.
Yes.
So this past paper discussion is very good, sir. Like we are touching up.
Sorry, I cannot hear you properly.
This past paper discussion is really good. If we can do one more next week also, like 2018 paper, it would be better, sir.
I
Because
don't
we
think.
lost a lot in the online classes also. So if we can do it, because this is very effective, we're learning a lot. So if we can do something like that, will be better, sir.
Yes, but
Very
I
thank
don't
you.
think now we can do that, because this is what we agreed, and now you have 2 weeks study leave period as well. I'm not sure whether we can do that, because we are about to start the new class or the new batch as well. Let's see. I'm not sure. Okay. Shall we take the break? Any other questions or concerns?
Sir, can you explain the last question again? The
last question.
Yeah.
This is about pricing futures. If you can remember, we discussed a model called cost of carry model. So what it says, if you are to buy the asset now, we have to pay for it, and once you to buy that, you need cash. For that cash, there's a cost, like interest cost. And holding that asset also, there will be some cost. Maybe you may have to insure it or put it in safe custody or storage cost, something like that. If you buy the asset today and keep it, say 1 year period, you incur a cost. So the futures price will be decided based on the price you pay today and add in the cost that you may incur. On top of that, you will get some benefits by holding that asset. So therefore, when we decide the futures price, we will deduct those benefits from that cost. So therefore, the ultimate futures price will be the spot price plus the cost that you may incur for holding that asset minus whatever the benefits that you receive. So if the costs are higher than the benefits, there will be a net cost. Then the futures price will be higher than the today's price. But if the benefits are higher than the cost, there will be a negative cost. That means benefit, negative benefit, net benefits. If the benefits are higher than the cost, there will be net benefits. So it will be deducted from the today's price. So therefore, futures price will be lower than the current price or today's price or the spot price. So that's why the price remains below 11,000. Or the futures price should be below 11,000. Correct? Clear?
Yes, sir. Thank you.
Okay. You just refer to the cost of carry model. Okay, we'll take a break. Now it's 10:40. We'll try to start around 10:55. Okay. Welcome back. Shall we start?
Yes, sir. Yeah.
You can see the paper. So we completed 25th question, 26th question. Which of the following is the riskiest single option transaction? Write in a call, buy in a put, write in a put, buy in a call. What's the answer?
Write in a call.
Write in a call. Why?
Call. Because downside risk we don't know.
We don't know. We don't know means like there's no end limit. We don't. There's no limit.
Risk is unlimited. Yes.
Risk is unlimited. Loss is unlimited. If the market price increase beyond the strike price, so it can go to any level theoretically. So the risk is unlimited. So therefore, writing a call is the riskiest option transaction. So do you want me to draw the payoff diagrams and explain this thing, or revise bit on options? I think we did this 2 weeks back. We revised options, so I don't think we have to do that. Whatever the things that we couldn't discuss during revisions, we'll pay more attention to that. It's good, isn't it? What's your view?
Yes, sir. Yes, I think it's better.
Yes.
Yeah, that's better, sir. We cover whatever the areas we didn't cover.
Yes. Then the next question, price value of a basis point is closely related to dollar duration, market value, yield change, all of the above.
Dollar duration.
Dollar duration. Why?
Because it measures 1 basis point change in the price, so change in price to response 1 basis point yield in interest rate.
What is price value of a basis point? That is the change in price if the yield is changed by 1 basis point. What is 1 basis point? It's 0.0001. That means 0.01%. 1 basis point is 0.01%. So if the yield changed by 0.01%, what is the change in value of the bond? So that is the price value of a basis point. It is closely related to dollar duration. Why? What is dollar duration? Is dollar duration gives us a dollar amount of a price change for a 100 basis point change in yield. Duration or the modified duration we interpret as a percentage change in price for a 100 basis point change in yield. That means for a 1% yield change in yield, what would be the percentage change in price? But dollar duration gives us the corresponding dollar amount. So that is for a 1%, but in the price value of a basis point, it is related to 0.01%. So the same the dollar duration figure divided by 100, we get the price value of a basis point. So therefore, it's very closely related to dollar duration. If you move to the next question, which of the following is not true on futures and forwards? So basically, this is a comparison between futures and forwards. The question asked, which is not true. Be careful on that as well in questions. Questions might ask what is correct or what is wrong, or what is true or what is not true, like that. So read the questions carefully. It is asking us to select the incorrect statement. What is the answer? A futures contract can hedge price risk much better than a forward contract. A forward contract is negotiated while a futures contract is standardized. Futures contracts require margin payments while forward contracts do not. Forward contracts are not traded on the exchange and carry settlement risk. So first we'll try to identify what are the correct statements regarding forwards and futures. Can the forward contracts and futures contracts be used to hedge? Forward contracts and futures contracts. Can we use those to hedge our position? Yes or no?
Yes. Yes, sir.
We can use both forwards and futures to hedge our position. But remember, in this sentence, it says futures contract can hedge price risk much better than a forward contract. Is there any difference of using a future or a forward to hedge? Is there any difference?
Yes, a future, the risk is lower than a forward contract.
Futures risk is lower than the forward contracts in the sense from the credit risk side.
Yes.
That's why if okay, we'll move into the next statements and come back to A. The answer is A. I'll explain that. So a forward contract is negotiated while a futures contract is standardized. So forward contract is negotiated. What does it mean? The terms and conditions. That means amount, value date, things like that can be tailor-made, customized, depending on the requirement of two parties. But futures contract, you can't do that. The settlement date or the last trading date is given, maturity expiry date is given, size of the contract is given. You can't change that. So it is, futures are more standardized, forwards can be customized or tailor-made according to the user's requirement. So therefore the statement B is correct. Statement C, futures contracts require margin payments while forward contracts do not. That is also correct. If you enter into a futures contract, you have to keep a margin with your broker and the broker will keep it with the exchange. But in forward contracts, generally it's not. Nowadays it's becoming popular and becomes a requirement or margining in between two parties, but it's not common. Then the last one, forward contracts are not traded on the exchange and carry settlement risk. That's what you mentioned. That's why you said futures contracts are less risky, forward contracts are risky, because forward contracts are just an agreement between two parties, over the counter transaction. So there is a risk of the other party. But in futures contracts, they are traded on the exchange. Through novation, the trade will be break into two trades between both parties and the exchange. So even the other party, one party defaults, the other party will get the whatever receivables from the exchange. So therefore the counterparty risk is minimized in futures transactions. So therefore B, C, D all are correct. But what's wrong with the statement A? As we discussed, futures and forwards both can be used to hedge our position. But the problem here is forward contracts we can customize. So we know what is the value date of our existing position, what is the amount. So we can create a forward contract to match our volume or the size and the dates. So we can hedge it more closely. But futures contract, it's not. The size is given. Maturity dates are given, or the expiry dates are given. It may not fit to our requirement. Size may not fit. The maturity date may not fit for our requirements. Therefore, though futures and forwards both can be used to hedge our position, forward contracts are much better in that sense. We can have a better hedge using forward contracts than the futures contracts. But here in the answer A, it says other way around. It says a futures contract can hedge price risk much better than a forward contract. So which is false. So the answer is A, because it's asked the incorrect statement, or which is not true. The A is not true, therefore the answer is A. The next question, you have a short GBP USD position. Which one of the following is the best call to square your position? What's the answer? You have a short position in sterling dollar. There are 4 calls and ask what is the best to square your position. Any answers?
Answer B 1.5299.
Answer B 1.5299. Any other answers? All agree with that answer? Okay, let's see. What does it mean by short GBP USD? You have sold GBP against dollar. Then to square that position, what does it mean by square? Eliminate the exposure. So you have what you have to do, since you have already sold sterling, what you have to do?
You have to buy.
Buy sterling. At what rate you would like to buy it? At the least cost or the lowest price. Correct? Whenever you buy anything, you would like to buy it at the lowest cost or the lowest price. So if we follow that logic, what is the lowest price? A, C and D all are 1.53, 1.53, 1.53. But answer B is 1.52 something, 5299. And what does it mean by 1. Sorry, this 05? What is the rate here? What is the offer in that code? Code B.
5205.
5205. Any other answers?
5305.
5305. So how can this be 5205 when the bid is 5299? Can the offer be 5205? The lower than the bid offer is lower than the bid. That cannot happen generally, and with such a spread, it's not possible. So that's how you read this. That should be 1.5305. Okay. Now this is 1.5305. There's a code 1.304. At what rate you buy? So remember, you want to buy, and you are a market taker. So you buy at the offer. The applicable rates are 18, 5, 15 and 10. All are 1.53. The big figure is 1.53 in all these codes. 1.5318, 1.5305, 1.5315, 1.5310. So therefore, the lowest offer is 1.5305. Therefore, the answer is B. Even though 1.5304 is lower than 1.5305, it's in the bid side, where you can sell. So therefore, this is not applicable for us. So the answer is this. But remember, just by looking at this, you cannot say it's answer B. You have to think about the offer side. because you are buying an offer, not at the bid. Next question, 30th one. The USD CAD 6-month points move from 155, 150 to 90 to 85. This could be explained by so what has happened, 6-month forward points has moved down. The reason could be again this is about the forward rate calculation and that equation. Yes, what's the answer? A. Yes, USD interest rate pricing. Why? In this pair, dollar CAD, dollar is the base currency. CAD is the counter currency. Okay, just check. This is 155 and 150. What does it mean? 155, 150. Bid is higher than the offer. What does it reveal? If the swap points bid is higher than the offer rate, what does it reveal? What can you say about dollar interest rate and CAD interest rate? This scenario arises when the swap points are negative. That means instead of adding swap points to the spot rate, we subtract swap points from the spot rate. That happens when, that means forward rate is lower than the spot rate. That happens when the base interest rate is high. Correct? When the base interest rate is high, swap points are negative. But here the question is, this negative amount has decreased 155 to 90 and 85. Still the relationship remains same. Bid is higher than offer. Still dollar interest rate is high than the CAD interest rate. But what has happened? When the swap points becomes 0, when the swap points becomes 0, swap points become 0 when the interest rate of both currencies are same. Then the ratio of interest rates would be 1, and forward rate would equal to the spot rate. If we go back to the forward rate equation again, spot forward rate equals spot times 1 plus RC divided by 1 plus RB. Again, I omit the adjustment day count adjustment. So this is the equation. What would happen? RC equals RB, then 1 plus R over 1 plus R. Both are same, RC and RB would be the same figure. So this will cancel out and come. The answer is 1. So this part is 1. S multiplied by 1 S. So the forward and spot rate would be same, flat. But if RC greater than RB, this ratio 1 plus RC over 1 plus RB is greater than 1. This ratio is greater than 1. Then S multiplied by a number greater than 1, you get a number higher than S. So this F would be greater than S. Other scenario, RC less than RB, then this ratio would be less than 1. Therefore, forward rate would be lower than spot. Now this in this example, stop points are given 150, 155, 150 is equal. Yes. And this has gone down to 92, 95. Generally, we know it should be lower than the offer. But in this case, bid is higher than the offer. In stop points, when you see this, we know these are not positive numbers. Instead, these are negative numbers. We subtract these points from the spot rate to a derived forward. So therefore, we know that this is the situation. Forward rate is less than spot. That means counter currency interest rate is lower than the base currency interest rate. Now, from minus 150, it has come down to minus 90. Rather, it has gone up from minus 150 to minus 90. It's increased. When do you expect stop points to increase? That is when the base current either to counter currency interest rate to go up or the base currency interest rate to go down. So that's what has happened here. So this gap has narrowed. Interest rate of base currency is getting closer to interest rate of counter currency. Then it will become close. Minus 155 becomes minus 90. So gap narrows. So therefore, this move can be explained by a reduction in US interest rates. So therefore, the answer is interest rate falling, not rising. If these were other way around, positive points, then the answer could have been interest rate rising. Correct? Any question? Next question, which of the following does not directly determine the fair value of an option? What are the factors that affect the valuation or the value of an option? He asked, in this question it is asked, out of given answers, which one is not included? What's the answer?
I think the answer is C. Because market price volatility and time to maturity determines, and therefore answer is C.
Yes. Yes. Correct. The underlying asset, current market price, the current spot price, and the volatility of the market in the market, and time to maturity, all factors into the pricing, but not any expectations. Expectations will not directly impact, but through the either the spot price or the volatility will be reflected. So the answer is C. The next one, a company treasurer needs to borrow 10 million euros for 180 days. 60 days from now, the type of FRA and the position he should take to hedge the interest rate risk of this transaction are FRA position, 2 into 6 short, 2 into 8 long, 2 into 8 short, 2 into 6 long. This is about a forward rate agreement. What is a forward rate agreement? It is a kind of agreement to borrow or lend in the future, not today. Sort of agreement to borrow or lend in future, but exactly what would happen? Either we agree to pay a fixed rate or pay a floating rate in future and for a period starting from future and for a period of time. So based on that, the first part will reflect what are those periods. So according to this explanation, the company wants to borrow 480 days and starting from 6 days now. So what would be the correct representation of that front?
Answer A.
Answer A.
A.
2 into 6 short. Okay. Before we decide whether it's short or long, whether it's 2 into 6 or 2 into 8.
2 into 8.
2 into 8. Why?
You need to add that two parts like
Yes.
under
The
60.
first figure shows us what is the time period between today and the beginning of the borrowing or
Contract.
lending. So in this case, 60 days. They need it 60 days from now. So 60 days. 60 days in months, it's 2 months. So therefore, first figure 2, it's correct. It's given. No argument with that. Then the second part is starting from 60 days, they want to borrow it for another 180 days. So in 2 months time, they will borrow for another 6 months. Then altogether time period from today is 8 months. That is the figure we use. So therefore, it should be 2 into 8. So it's not answer A, not answer B. It should be answer B or C. Then what we have to decide whether it's a long position or a short position. What does it mean by a long FRA? What do you agree in a long FRA? In a long FRA, we agree to, oh, long means buy. What do you buy? You buy the unknown things, not the known things. You buy the unknown things. What is the unknown thing here? Is the floating rate. What would be the interest rate that vary? So we'll buy the, in a long FRA, we'll agree, we agree to receive the floating rate while paying the fixed rate. In a short FRA, we agree to pay floating rate while receiving the fixed rate. Now, what we have to decide, based on the company requirement, what is the risk and what should they do, or the treasurer should do. Company wants to borrow, then what's the risk? The company wants to borrow in 2 months' time. What is the risk?
Interest rates moving up.
If the interest rate goes up, they will have to pay more interest. Oh, at the time they are borrowing, their interest cost increase. So therefore, what they want, what do they like to do? Fix the exchange rate, sorry, fix the interest rate today. Then they know this is the interest rate that they are going to pay. Even if the interest rate increases, there's no problem. So in a FRA, what they want to do, pay the fixed rate and receive the floating rate. That's what they want to do. So paying fixed, receiving float, is it long or short? Receiving float means you are going long. You receive the unknown. So therefore the answer is 2 into 8 long. The company treasurer has to buy a 2 into 8 FRA. Any question? So if not, we'll move into the next question. So, okay, this is about how do you interpret the value at risk? If the 1-day value at risk of a portfolio is $50,000 at a 95% probability level, what does it mean? That's the question, simply. What's the answer? How do you interpret the value at risk figure? So you can interpret it.
Answer B.
Answer D.
B.
B. B.
20 days,
20 days, the portfolio will decline by
50,000 more.
or more. Okay. Correct. But what does it mean? So how do you interpret the value at risk figure? That is the maximum loss that the portfolio may incur within the given time frame and at the given confidence level. So in this example, what does it mean? The portfolio may lose maximum of 50,000 during a 1 day at a 95% confidence level. So you have 95% confidence that the loss during a day would not be more than 50,000. Correct? So with the 95% confidence level, the maximum loss would be 50,000 within a day. But what does it mean? On the other hand, someone can say that is the minimum loss that can incur by the portfolio at a 5% level, 5% significance level, because when we say there's a 95% chance this is the maximum loss, there's a 5% chance the loss can be more than 50,000. Within that 50,000, within that 5%, 50,000 is the minimum loss. So the VAR figure can be interpreted in both ways, as a maximum figure or as a minimum figure, but it is easy to interpret it as a maximum figure as at this confidence level, because now we can say 95% confidence level, but 5% we cannot say it's a confidence level. We have to say it's a significant level, because it's 1 minus 95%. So that is the interpretation. So we have a 95% confidence that the value of the portfolio within a day will not decrease by more than 50,000. Okay, but there's no such answer. The period given here is 1 day, but in the answers it's talk about 20 days. What does it mean? Why? That is the interpretation of 95% probability level or the confidence level. So when we take 100 days, there is a chance out of that 100, 5 days, the portfolio may incur losses beyond 50,000. There's a chance because our confidence level is 95%. If we take 100 days, out of that, the loss can be more than 50,000 out of in 5 days. Out of 100, in 5 days, the loss can be more than 50,000. But here it says this means that we would expect that in 1 day out of 20 days. What does it mean? 1 over 20. Still, it will be the 5%. If we take 20 days, out of that 20 days, in a 1 day, the portfolio value may decline by 50,000 or more, or the loss may be 50,000 or more. Still, this talk about 1 day out of 20, discuss about the 5% chance that is going beyond this 50,000, that 5% chance. So therefore, the answer is 20 days, the portfolio will decline by 50,000 or more, because we are talking about the tail or the extreme scenario. 1 day out of 50 days means 5%. There's a 5% chance that the portfolio value will decline by more than 50,000. So be familiar with how to interpret value at risk figure. It can be done in both ways, is either as a maximum value with the confidence level, or as the minimum value with the significance level. Shall we move to the next question? Okay, again, the next question is about risk. Which of the following risks are not present in a short dollar yen spot position done today. That means you have sold dollar against yen. In that position, what are the risks, or which of the following risk is not present? When you sell short dollars, will you face or get exposure to market risk, counterparty risk, basis risk, or settlement risk? When you short or when you sell dollars against yen, you get the exposure to the market risk, because if dollar yen exchange rate increases, you have to buy it back at a higher rate. So you may lose. Counterparty risk. Yes, whenever you enter into a transaction with another party, especially in like FX, there will be a settlement risk. Basis risk, where you can see the basis risk. The basis risk comes in either two different interest rates, like if you agree to pay and receive two different floating rates, then that can happen in interest rate swaps, or maybe futures. Especially in futures, we see the basis risk. What is the basis we define in futures transaction? How do we define the basis in futures transaction? Can someone remember? So, however, the basis risk is not appear in this transaction. It's not relevant. The settlement risk, yes, that can happen on the settlement date. Due to some reason, the settlement may not take place. So, therefore, in this position, you don't face any basis risk, but all other market, counterparty, and settlement risk. So, therefore, the answer is C, basis risk. Question number 35. Which of the following $1,000 face value securities has the highest yield to maturity? I think we discussed this question. Face value of the bond is 1,000. It's asking which of the following will give you the highest yield to maturity. So maturity of the bond is same for each answers. So it will not give any clue. Coupon is also same. So there won't be any change. Only thing that we have to compare is prices. 600, 800, 1000 and 1500. You know the relationship between yield and price. If yield increases, price decreases. If the yield is equal to coupon, then the price would be par. That means same as face value. So therefore, in this case, price equal to the face value. Therefore, yield is 5% in this case. But in this case, when the price is 1500, what does it mean? Yield is less than 5%. When the yield is less than the coupon price, the bond will be traded at a premium. That means higher than the face value. So both C and D are out. But A and B both are at a discount. That means yield is higher than the coupon rate. Therefore, the price is lower than the face value. So in these both scenarios, A and B, yield is more than 5%. But when the yield increases, price decreases. So therefore, the yield in this case is higher than the yield in the when the price is 800. So the answer is A. Clear? I think we discussed this during revision class as well. Question 36. It's about a treasury bill and discounting. What's the answer? A 182 day treasury bill with a face value of $5 million trades at a yield of 7%. What is the consideration payable when you buy this bill? More than face value, same as the face value, less than the face value, or too little information to decide. What's the answer?
C.
C. Why? So see, I can easily convert this question into a true or false type. So I give the same explanation and I say, so when you buy this bill, you pay less than the face value. True or false? Then you have to say whether it's true or false and explain. Now you said the answer is C, less than face value. Correct. Why? Is it a guess?
Discounted product.
Yes, treasury bill is a discounted product. So unless the yields are negative, you pay less amount than the face value to buy any discounted product. So you pay less than the face value to buy this. It's a treasury bill, it's a discounted product. You pay less than the face value. So it's a very straightforward question, an easy question. You should not take 1 minute to answer that question. Question 37. You bought 10 million euro against GBP at whatever rate on January 3rd, 2019. It says it's a Thursday on spot basis. January 7, 2019 is a Monday and a holiday in the United Kingdom. What will be the settlement date? So basically you have entered into a spot transaction on 3rd January, Thursday, and ask what is the settlement date, but it's a Monday, 7th January Monday is a holiday in the United Kingdom because the currency pair is Euro and GBP. What is the spot date?
I think the answer is D, because spot transaction is T plus 2. Since Monday is a holiday, Friday and Tuesday.
Yes. So spot settlement date falls 2 business days after the trade date. So your trade date is 3rd January on Thursday. The next business day is 4th January, Friday. So this cannot be the next or the settlement date, spot date. Then 5th and 6th are holidays in both countries, Saturday and Sunday. So 5th and 6th cannot be the settlement date. Then next business day is 7, but it's not a business day in United Kingdom. So therefore, you cannot consider it as a business day. So 7th is also out. Then the next business day is 8th January, Tuesday. So 2 business days after 3rd January is 8th January 2019, Tuesday. That's the answer. D is the correct answer. Which of the next question, which of the following is not an instrument is used by the central bank to control the market liquidity? What is market liquidity? What is market liquidity?
Availability of funds in the market.
Availability of funds in the market. So banks, after fulfilling their SRR requirements and other obligations, whether they have excess funds or they are short of funds. Some banks may have excess funds, some may be in a short position. So those who have excess funds will lend to the banks with short positions. Even after settling down all these, there will be excess funds available in the market. That is the liquidity position. Or it may be in aggregate, the whole market may be in a short position. That is all. That is called market liquidity. As an aggregate, whether the market has excess funds or short in funds. So market liquidity. To control that, what are the instruments used by the central bank? What is open market operations? What is open market operations?
Lending and borrowing.
Lending and borrowing by
Excess fund or
who is the lender, who is the borrower? Oh, who are the lenders, who are the borrowers?
Central bank and commercial banks.
Central banks and commercial banks. So, but specifically in the open market operations, what does it happen there? The central bank assesses the market liquidity. If there's excess funds in the market, central bank will try to absorb that liquidity or take out that liquidity from the system. Otherwise, there will be an impact on interest rate. Interest rate will go down because you have enough funds. There's no one to borrow. So you will reduce the interest rate. You want to lend it. You don't want to keep it without lending it. So there will be an impact on interest rate. Interest rate will start to decrease if the market is having a excess liquidity position. So central bank will try to absorb. What is the product that they use?
Repo.
Yes. They will announce a repo auction, repurchase auction. That means central bank, from central bank side, it would be a repo transaction, giving securities and taking cash. But if the market is short in liquidity, central bank will do the opposite, reverse repo, inject cash into the system and take securities as collateral. So that is open market operation. What is the statutory reserve requirement? So therefore, it is one of the instruments used by central bank to control the market liquidity. The SRR, what does it mean? That is the minimum percentage of deposit, outstanding deposit liabilities that any bank has to keep with the central bank. Out of their deposit liabilities, a certain percentage they have to keep with the central bank. That is the statutory reserve requirement. If this is high, what would happen? If you take 100 rupee deposit, if the SRR is 10%, you have to place 10% with the central bank. Then you can lend only 90 rupees. If it is 2% as now, if you take a 100 rupee deposit, you have to keep only 2%. With the central bank, you can lend 98%. So the market liquidity will go up. So changing the SRR, central bank can change the market liquidity. What is the discount rate? It's not that used in Sri Lanka, I think. Not used in not used in near, or maybe 10 years or 10 years or more than that. That is the window a distressed bank can use ultimately to borrow from the central bank at a high rate. So again, that will have an impact on the market liquidity. So therefore, first ABC, all three options are correct. But what is gapping? Gapping is the concept that we used in asset liability management or interest rate risk management to see whether we have more assets or liabilities in a particular time bucket. Then we can gauge whether we have any interest rate risk or whether we have any funding risk. So the answer is D, gapping. 39th question, a bond has a par value of 5,000 and a coupon rate of 8.5% payable semi-annual. Face value 5,000, coupon rate is 8.5 and semi-annual. What's the question? What is the dollar amount of the semi-annual coupon payment? Okay, basically it's asking to calculate the coupon payment, semi-annual coupon payment. What's the answer?
Answer A, sir. 212.50.
Answer A, 212 and 50 cents. How do you calculate it?
5,000 into 8.5%, and it's divided by 2.
It's divided by 2. Yes. The equation is coupon equals face value into coupon rate divided by coupon frequency. What is the face value? What is the coupon rate? What is the coupon frequency? That means how many coupons are paid during the year. So in this case, in this question, face value is 5,000. Coupon rate is 85%, and frequency is, so you get 212 and 50. Correct? The last question, an investor paid a full price of 1059.0 for each 400 bonds. The purchase was between coupon dates and accrued interest was $23.54 per bond. What is each bond's clean price? So basically full price is given, accrued interest is given. You are asked to calculate the clean price. I think you know about full price or the dirty price, and accrued interest and clean price. Yes or no? What is accrued interest? What is accrued interest? What is accrued interest?
Interest from last coupon date to current settlement date.
Yes, whatever the interest accrued on the bond from the last coupon date to the settlement date, because the interest are paid on coupon dates. But whenever you sell a bond in between coupon date, the seller should get interest for his holding period from the last coupon date to the current settlement date. Whatever the holding period, for that the seller should get that interest, because he had that bond in his possession. He is the investor. So that interest amount is called accrued interest. Then what is dirty price?
Clean price plus interest, accrued interest.
Clean price plus accrued interest. What? Correct. What does it mean? What is clean price then, at least?
The clean price is dirty price minus the accrued interest.
Okay, now we have like chicken and egg dilemma. Dirty price and clean price. What are those?
Clean price mean market price.
Without accrued interest.
Yes, what is the consideration that you pay to buy that bond without accrued interest? With the accrued interest, it is the dirty price. Clean price is the price that you pay to buy that bond without accrued interest. That's the consideration that we pay. Okay, now you know the equation. Dirty price or the full price equals clean price plus accrued interest. So dirty price is given, accrued interest is given, then what is the clean price? If you know that equation, this is a very simple calculation. 1059.04 minus 23.54. 59.23. So answer is
B.
B. 1035.50. Okay, that's about all or the section A. All 40 short questions. So at the exam, you should be able to do this in like less than 1 hour. Sorry, it's about 80 minutes. Yes, 72 minutes. If you can do this in 1 hour and 15 minutes, or basically if you can finish this by 1 hour, it would be great. So you can understand the way how you should answer this MCQ questions. So don't do calculations unnecessarily. Now each and every questions that you need to perform calculations. Without doing any calculations, even though the answer is a number or the lot of numbers are given, no need not to do any calculation. Logically, you can derive the answer if you know the concept. So say this treasury bill question, easily I could have put some numbers here, but still you can answer without any calculation. If I put 3 numbers with or 2 numbers with more than 5 million, one is less than 5 million, and the other one keeping the too little information to decide, still you can answer without doing any calculation, isn't it? So just because of you see numbers in answers or the question does not mean that you have to do calculation. What I'm trying to test you whether you have understood the concept and the relationships between different variables and things. Okay, we have about another 15 minutes. What do you want me to do now? Now this one, I think we didn't discuss about this spot trade. This is not the FX spot rate in interest rates. So that's why I told you, don't expect the like this question to be the bond and the next one to be the FX, like that. And not only like if we take this is a bond question, this is a FX question, then this is about derivatives, futures and options. This is about ALM gap analysis. Don't expect like that. This is about regulations. No need to be like that. It can vary, but the basic structure will remain the same. Any questions? So, any questions? Okay. If you don't have any questions, even in this essay type questions, do we have to do you want me to discuss any of these?
Question number 4. Sir.
Okay. Question number 4. It's about forwards. Calculate the 3-month forward price for a barrel of crude oil if the current spot price is $6, 3-month interest rate is 0.75% per annum, and 3-month storage cost in floating tanker are 1.5 per barrel. Okay. This is about again cost of carry model. What is the? Can you see the board? Now you can see the board. $62 interest. Okay. Spot price is $62 per barrel. Interest rate for 3 months 0.75% per annum. Storage cost $1.5 for 3 months per barrel. So, what is the futures price? What do you do? It would be spot price plus cost. There's no benefit. There are no benefits given in this example. So, spot and cost. Spot is straightforward, 62. What are the cost? This interest cost and the storage cost. So, 62 as I'll write it. Cost divided into interest and storage. So therefore, 62 plus what is the interest cost? For $62 at 0.75% for a 3-month period. So 90 days divided by 360 plus storage cost, it's straight away given $1.5 per barrel for a 3-month period. Okay. So if someone can do the calculation and let me know the answer. What's the answer?
$63.62.
63.62.
62.
Yes, 63.62.
This is the futures price. So next question, assume that the above future is trading at $64 per barrel in the market. Identify whether there is any arbitrage opportunity. Write down the transaction that you carry out to make the arbitrage profit, if there's any arbitrage opportunity in this market. So this futures is trading at 64. Is there any arbitrage? Yes or no? Is there any arbitrage opportunity? Yes or no? $63.62 is the calculated value, what we get from the model. 64 is the market value. Is there any arbitrage opportunity?
Yes.
Yes. Why?
Market value is higher than the fair value.
Higher than the fair value. So what do? What are the transactions that you carry out? One is expensive, one is cheap. What do you do?
We set at 64.
Sorry? It was not clear for me.
Sell high, buy low.
Okay, yes, sell high, buy low. Now what do you say?
We sell the futures at 64 and
Yes. First one,
buy the
sell futures at 64. Then you do this transaction in the market. You enter
and
into a
we receive the funds and invest those funds in the current rate.
once you sell a futures contract, when do you receive funds?
After the expiry.
On the expiry date. But Yes. But meantime, we have to keep a margin. Not that you receive, even you have sold it, you have to keep a margin. You won't receive any funds until the settlement date or either you close out your position. So you don't receive any funds here. This is just an agreement. You have to maintain the margin. You have to keep some amount with the broker. How do you explore this opportunity, this arbitrage opportunity? You should be able to make a profit of 38 cents. The difference between 64 and 63, 62, this 38 cents is the arbitrage opportunity or the profit. How do you explore it? You sell a futures contract in the market, then what you have an obligation to deliver oil in 3 months' time. Then you will receive $64 per barrel. What do? Since you have sell a future, now to hedge that position or cover it up, what you should do? You have to buy the same thing. Not to have any exposure to the market, you have to buy the same thing. But you cannot buy it. You have sold it. What do? You synthetically create a futures long position. That means a buy position. What do? You want to deliver, you have to deliver oil in the future. So therefore, what do? Buy oil spot. That means you pay $62 to buy a barrel. You buy oil now. Then what do? Then you have to store it. Store and pay storage. That is $1.5. To buy oil, to pay this $62, you need cash. How do you raise that fund? You borrow dollars for 3 months at 0.7 per annum. To borrow cash, use that cash to buy oil and store it. After 3 months, what would happen? You have oil barrels, you deliver it, you will get that $64, and out of which you have to pay for this storage cost and this interest. It will be only 63.62. The rest is your profit. What do you call this? This is what we call cash and carry. The other side, if it was future price is less than 63.62, what do? We do the opposite. Buy the future, short sell the underlying, invest cash. What do we call it? Reverse cash and carry. Consider the following put option on $LKR. Draw the profit diagram for a buyer of this option at the expiry. Can you do that? You are a buyer of a put option. Yes. What is the payoff diagram of a for a put option, long put option? Through a put option, what do you get? If you are if you are a buyer of a put option, what you can do? If you are a buyer of a put option, what you can?
Right to sell.
You have a right to sell. Okay. Is it payoff or the profit diagram?
Profit diagrams.
Profit diagram. What's the difference? It's a put option. So first mark the strike. What is this? 182. If the market price on the expiry date below 182, what do you do? If the exchange rate on the expiry date is less than 182, what do you do?
You exercise
We exercise the put option.
You exercise your put option, you sell it at 182. So then you make a profit. But out of that, you have to deduct the premium of 2 rupees. So if the price is at 182, you lose 2 rupees. Correct? At the strike, there's no gain on the option. Either you exercise or not, it's indifferent. You can sell at 182. So from the option, you don't get anything. But you have already paid the premium and incur a cost. So therefore, the loss is -2. But when it comes to 180, what would happen? If the spot price is 180, you will exercise your right. You sell $Rupee at 182 when the market is 180. What is your gain? You get this 2 rupee difference. But you have already paid the premium of 2 rupees. So therefore, profit would be 0. This is the break-even point. So during this time, you will exercise your right. So you will gain something from the option, exercising the option, but still there's a cost incurred by you, which is higher than your gain. It will be a loss, but gradually decrease. So it will be like this. Below this point, what would happen? Right to the break-even point, say 150. You will get all these 32 rupees as the gain from the option and less 2 rupees. So it will be somewhere here. This proportion is not good. This may be 30 rupees. Okay. Likewise, it goes like this. What is this? 180. Left hand, sorry, right hand side of this point, strike price. If the spot price is higher than strike, what do you do as a put option buyer? You don't exercise your right. You let the option to be expired, but you incur the loss equal to the premium. So the profit diagram remains same. So this is the profit diagram for this. So this is the general shape of a profit diagram for a put option buyer. You can draw this, but remember you don't get full mark for this picture. You have to specify or mark all these things. 2 rupees, 180, 182, 180 here. This one is not required. Just to explain. What is the maximum loss? What is the break-even point? What is the strike price? Exactly at that point you get this. And what is the maximum profit that you make? That has to be done. Okay, the next question is 80 rupee call option on a stock trading at rupees 83 is priced at 6 rupees. What is the time value of the option? In options, we discuss about intrinsic value and time value. Can you remember? So the premium is intrinsic value plus the time value. So in this case, rupees 80 call option, what does it mean? ₹80 call option means strike is 80. On a stock trading at 83, spot is 83. It's a call option. And the premium is 6. What is the time value of the option? What is the intrinsic value of this option?
Three rupees.
3 rupees. Why?
X
This
minus.
option is a call option.
Sorry.
Strike is 80. Spot is 83. Already this option is in the money. If it is an American option, you can exercise it and get a 3 rupee gain. So the intrinsic value is 3 rupees. But the premium is 6 rupees. Premium equals intrinsic value plus time value. Since there's still time to maturity, during that period, spot price can vary volatility may change, therefore there's some uncertainty. To compensate that, we'll have to add this time value. So we know the premium 6, intrinsic value 3, so then the time value is also 3. That's the difference between premium and the intrinsic value. Clear? Any question?
Can you just show us how to calculate find the frequency in a EAR when the EAR and the rate is given?
What's the equation?
Actually, the EAR, yes.
EAR equals 1 plus rate divided by m to the power m.
-1.
Yes, minus 1.
So actually, there's a sample question given in that paper you are given. EAR 4.08 and R is 4%. 4.08, R is 4%, and it is asked to calculate the find the frequency.
Yeah. Okay. Then 1 plus R over M to the sorry. Yes, this X is there equals 1 plus EAR. Correct? You take this one to this side, then it becomes 1 plus EAR. This side remains the same, we can switch it when we write. So then the problem is, how do you take out this? What do you do? This is the mth power. Now you have to take the mth. So you have any idea about logarithms? Do you have any idea about logarithms?
No, sir. No, sorry, no, no idea at all.
E to the power this. If not, you may not be able to do this. So what I've done, took the log to the natural log of both sides, then it will come to this. Still I have a problem. I think to do this, you may have to try a trial and error method. That's the way that I can give to you at your level. Was it there in the sample question?
Yes, actually, it was there. I did the rest. This one I got stuck. I couldn't do because of the mathematics.
Yes, yes. Don't worry. You won't asked to do this. Then you need a.
Okay, thank you. I hope it won't come in the exam.
It's not straightforward. Only these two given and asked to calculate M. No? Yes. It's okay. What you can do. This is EAR. This is
That is our rate.
R. So what you can do is like this. Try what you get there. Then if this is not work, just do a small adjustment. If say you get 4.09 something, what does it mean? This is too high. Make it bit low. Likewise, you have to do a trial and error. And I think you can do it in the Excel. However, don't worry for the exam. You won't get this type of question. You need this even in bond calculation. I cannot ask you what is the yield. Given the price and coupon rate. If you know the coupon rate, yield, you can calculate price. But giving price and coupon rate, I cannot ask you to calculate yield. Because this equation is also not linear. It has to be done on a numerical method, iterative method. So don't worry. But I'll ask the relationships, not the calculation. Anything else?
So in the question number 3, can you explain the third and fourth one?
Question number 3 in the past page.
Yes.
Third and fourth one on your code manager trade division profit. Okay, so it says in the previous one, no need to consider the previous one. What is said. So your trading desk here, corporate desk here. You have provided a code to this party, and manager of this says we sold JPY 2 million or whatever amount. Okay, what has happened now? This guy has sold to a corporate again 2 million. What does it mean? Then if we consider corporate buys 2 million, yeah. Then what this guy has to do the same thing with the this. This has to buy this. This guy has to buy. Yeah. Then what do you have to do? Cover that. You have to go to the market and buy JP because this is what you have sold. Oh, this is what the corporate client has bought. Corporate client has bought 2 million yen. So the corporate desk has to buy from you 2 million yen. Now you are short in 2 million yen. You have to buy 2 million yen. But against rupee, how do you do that? So ultimately, what do you want to do? Buy JPY 2 million and sell LKR. Can you go to the interbank market or somewhere and do this trade straight away? No, you can't do that. What you have to do first? You sell LKR and buy US dollars in the Sri Lanka interbank market. Then what do you do? Sell this US dollar and buy JPY in the international market. The amount that you have to calculate based on the exchange rate prevail, you need 2 million here. Then this may be about 0.2 million, 0.02 million, something like that, or even less than that. The same amount goes here. Based on the dollar rupee rate, you decide the rupee amount. But in this example, I don't, this question, I don't expect the amount to calculate amount, but mention this. Just write sell LKR and buy USD, or buy USD LKR or whatever way, and this one. The order, it doesn't matter. Then the fourth question on that is what sort of limits, or what are the limits that you have to consider before you execute the above mentioned transactions in the market. So when you execute these transactions in the market, what are the things that you have to consider? What are the limits? As a trader, you might have a trader limit. You may have counterparty limit. Things like that you have to consider. So whatever applicable, you have to write. Anything else? So you can see, though the question is long, answers are very short. Shorter the question, the answer is longer the answer. When you have long questions, the answers would be short. So,
sir, since this is the last class, can we do a usual foreign currency sum, sir? Usual one that comes frequently.
I didn't hear that.
Since this is the last class, can we do a foreign currency sum, sir, which comes usually some usual type foreign currency sum, sir?
I don't think now we have time to do that. Lot of foreign currency examples we discussed at the previous revision. We did a whole full question in foreign currency in that class. Essay type question, if I remember correctly. Yes, there was a question. Someone asked me to do that on the from the simple sample questions. Now I don't think we have time to discuss the whole question. So even in this paper, what is there? Again, to calculate the forward rate and compare whether there's and see whether there's any arbitrage opportunity, like what we did in the futures. Only thing is to calculate the forward rate, you have to use the equation. In the second one, I think it's a calculation of cross rates, what we did in the morning. Same thing.
Sir, can you have 2018-17 papers also?
I don't think you will get it. I'm not sure whether they have. So you have sample questions. What I gave you. That will cover all those things. Even you go for the sample or the last 2017-18 papers, it would be almost same, but there's a risk. There may be some topics which we didn't discuss this in 2018 and 2019. In 2000, the like questions, fifth and sixth question. Fifth and sixth question. Yeah, in the past papers 2018 and 2017, those were not there. Like ALM and that difference is also there. However, there's no guarantee that whether we get in that same order or same topic here. But previously it was not there. Only in the last year I included that into the essay questions.
So any COVID-19 relief measures in the exam?
We can send you to a quarantine center. once the exam is over, if you all are lucky enough, you all can go to the quarantine center. So don't worry. So whatever we discuss, whatever the presentations we shared with you, study those and do the sample questions, and you try to answer this 2019 paper by yourself. As I told you from beginning, you have to work. That's the only way. So just note down what I've written on the board or what I've told. It won't work. So you work out, then you will find your own problems when you do these things. So instead, indeed, if I was a student here, I don't let the lecturer to or the resource person to go through each and every question. I have tried the questions and I'll ask the problem that I have faced when I'm doing these things. When you do these things, you will find problems. You will find the areas which are not clear for you. Then you can clear it. You try these questions, sample questions. Then you will realize whether okay, there's an equation. Whether should I put the numbers in decimal forms or percentage forms or things like that. So now it's too late. So, but do it. You have 3 more, at least. Oh yes, 3 more weeks to do that. At least, because we are not sure whether we will be able to conduct the exam on 21st. Still, I hope this. I heard they are going to open the schools as well in Western province. So if it is the case, we'll be able to have the exam on 21st. So don't postpone learning, assuming that we may not be able to have the exam on 21st. Assume that we are going to have it on 21st and ready for that. Then even in the worst case, you will be better off. It won't waste anything everything will be useful. So don't think like that. Assume the exam will be held on 21st and work towards that. Anything else?
So small thing. When we are calculating the bond prices, okay, by writing the cash flow series and when using the formula, the final answer, there's a difference. No?
No, can't be.
Can't be.
Only thing is, say when you discount each and every cash flow and write down the numbers, if you don't take the full, so there may be rounding off problem. If the figure comes in 4 or 5 decimals and you write only 4 decimals, that difference matters at the end, whether you use the annuity equation or the cash flow method. That's the only reason I can see to get 2 different answers. If you do it with full figures, you should get the same. That's why in reality you cannot go with these 2 decimals. In this calculation it will be 5, 6, or in US Treasury it's up to 8 decimal points, because when you multiplied it by million and billions, the last digit in decimals would be in thousands or hundreds of dollars. You can't omit that. But in the exam, don't worry about that. Just like take it up to 4 decimal points and do the calculation. And you won't get more than maximum 2 marks for the final answer if it is a essay type of questions. I'll give others to the equation, or if you have used equation to the equation and correctly term all these things and substitute correct figures into the equation and things like that. The final figure, the answer, it will be probably 1 mark, most probably. That depends on the type of the calculation and number of steps that you have to follow. In essay types, yes, I tell you, write down the equation first and define all the terms in that equation properly, then substitute the numbers. Without just substitute, if you just write the equation with numbers first, and if one of them is correct, I cannot give any marks because I don't know what you have done. So first write down the equation whenever you use equations, essay type of questions. Okay, anything else? If not, we'll stop here. So don't worry, but study well. Don't give up and face the challenge. I hope you all can do this and go through this.
Sir, how many mark allocates for assignment?
20, because we were about to do 2 assignments and allocate 20 marks now. So we decided to, with the 1 assignment, to allocate 20 marks for the assignment.
Okay, sir.
Okay, then we'll stop here. All the best. If you have any comments, you have my email. You can send. So if you